All right, welcome. We're going to let a few more people jump on here before we really get rolling. But I just want to thank everyone for joining us for day 2 of our 2-day event on not only surviving but thriving during the coronavirus, crisis, pandemic, what have you, that we're all experiencing right now. This is we're going live here, April 22nd, 2020. So I think the whole world is in the midst of this. I know personally, our family, we're the beginning or mid part of the way, I guess, through week 6 of self-isolation and social distancing, et cetera, et cetera. So I'm your host for this event, Deepak Saini. Again, I'm a health, performance, and longevity coach, and I just help people get the best out of themselves, whether that be cognitive function, losing weight, or wanting to live to be a centenarian like myself. So I've put together this panel of fantastic speakers, and yesterday I spoke, as well as Walter Wirch, who talked about the stock market, et cetera, and what's happened and where we're heading. And today, to start off with, we have David West, who is, he's got a bunch of specialties, but today's going to be talking about wills and estate planning. David, very involved in the community, sits on a bunch of boards, wonderful family, a very energetic dog, and of spending time in the mountains and getting out, and I think he might be trying to train for a marathon as well. I'm sure I'm not doing his intro much justice here. I'll let David jump ahead and maybe say a few words about himself before he jumps into it.
Sure. Hello, everybody. So I'm the principal and owner of West Legal. So we've got a few lawyers here. We practice in a few different areas. My specialty is residential real estate, and wills and estate planning are the two areas where I spend most of my time. We also do employment law, family law, some litigation, and a few other odds and ends here and there. So firm has been in business for about 3 and a bit years. I've been a lawyer for longer than that, but that's how long we've been at West Legal. So today I wanted to talk about wills, estate planning. This is one of those topics where almost universally we all know that we should have a will, that we should have an estate plan. We know it's the right thing to do. If you're anything like me, and Deepak, sounds like you're in the same boat, you plan on living forever. So
not forever, just 100 plus. That's all.
So this is actually common. A lot of people say, "Yep, I'll do my estate plan when I'm 95 and closer to to the end of my life." I literally hear that all the time. So, hoping to just address a few key points here to emphasize the importance of it, but more importantly, how easy it really is to have an estate plan in place. This is not rocket science involving teams of lawyers and things like that. It's pretty straightforward. The time commitment is nominal. There's a financial investment in it, but same as an insurance policy or whatnot, right? So I want to cover 4 key points, and time permitting a 5th if we can. So I want to talk about why you should have a will. I want to talk about what happens if you don't have a will, what happens to your estate and whatnot after you've passed. I want to talk about choosing an executor. This is a common question we get from clients a lot. Who should I choose? Who's the best option? And I want to talk about how simple this can be with or without lawyers. So with that in mind, let's start off with why you should have a will. Believe it or not, in Canada, somewhere between 50 and 60% of people do not have a will. There are a number of reasons why. Quite often it's just procrastination. People say, yeah, I'll do it, when I have the time or when I have the money or, when I'm a bit older, or, for the young people, they say I'll do it when I have kids or when I actually have some assets that I want to pass on to people. There's always a good reason why people don't do that. Sometimes it's a financial barrier as well. People say, I really don't have the money to do a will right now. This is something we're going to address later on in this webinar, talking about cost-effective options if it's a financial barrier as to why you don't do one. Other times it's people just saying, I don't even know where to start. I don't have any lawyer friends or lawyers in the family, and The process is overwhelming, looking at all the lawyers advertising their services out there. So where do I even begin looking at it? All valid reasons. These are all valid reasons why people don't have a will, and would explain, at least in part, why half of Canadians don't have a valid estate plan in place. It's important that you have a will. I always tell my clients, most importantly, what you're doing with a will is you're giving your loved ones the gift of decision making. You're taking that burden of making some tough decisions, putting them on paper so that they don't have to. You're not leaving them with a burden of having to decide things and step into your shoes and say, well, what would so-and-so have done and under these circumstances? What were their last wishes? They didn't tell me, they didn't write anything down. And so it really is a gift of decision making. Is what you're doing, more importantly than anything else. But it's important to remember that you're capturing your last wishes. If you want your wishes to be carried out, you need to write them down in some format. If you have minor children, very important, choosing a guardian, making sure that your kids are taken care of, making sure that your goals and dreams and aspirations for your children are put on paper. And so you can provide the resources and the guidance and the proper personnel to help your kids, achieve what they're going to. Legal guardianship is an obvious reason why, if you have minor children, those can get turned into messy situations if you don't have the proper guardians appointed. Reducing the risk of arguments in court. These are some of the ugliest disputes that I've seen as a lawyer, is in surrogate court, watching these family members being split apart, fighting over an estate because the instructions were not drafted in black and white. There were shades of gray, or there were no instructions. And so these are ugly disputes that wind up in the courts, and you're leaving it to a third-party judge to make a decision about the estate, which you hopefully shouldn't do. When we talk about the financial barrier to getting a will, it's important to think about the financial barrier of not having a will, the financial implication of that, because it can be huge. Court costs are expensive. If there's a dispute, the estate will often pay for those court fees or the legal fees for two sides to fight over an estate, and oftentimes they'll fight till there's nothing left. It becomes what they perceive as a moral victory, and it's really nobody wins in that situation. I suppose the lawyers do, but that's not who you should be rooting for in doing your estate plan, for sure, is for the lawyers to come out on top. It's just not sound planning, obviously, right? So one other reason why it's important to have a will is gifts to charity. What I find professionally with my clients is, when you're young and you're starting a family and you're developing a career or whatnot, you have priorities at that time. Keep food on the table, pay down the mortgage, hopefully put some money away for retirement, things like that. That should be where your priority is as a young person. But as you get older, you raise your family, you become empty nesters, your volunteer work becomes more important, and the work that you do for charity becomes more important. I've seen this lots of times where older clients have more of a focus on their volunteering and their charitable giving, and they want to leave something for charity, which is impossible if you don't have a will. Charities won't get anything. So we're going to talk about that in a minute. But again, another important reason why you should have a valid will. When we talk about what happens if you don't have a will, I ask this question often in presentations or with clients, and the first answer out of everyone's mouth is, oh, the government's going to get my money. Possibly. That's way, way, way downstream, though, from where your assets will go if you don't have a will. So without a will, the legislation takes over and it dictates who are the proper beneficiaries. And so you might like the end result. For most people, the first couple of degrees of distribution are fine with them. And then it gets way out there where they say, wait a minute, I'm not in favor of this. So it'll go, as you might expect, to your spouse first, to your children and grandchildren second. Your parents and grandparents are third in line. Your siblings would be next. And then after that, it moves on to aunts, uncles, cousins. And then finally, government way down the road. People are generally fine until you get to maybe siblings. If you're not close with your siblings, that might, may not be your ideal outcome. But by the time you get to aunts, uncles, cousins, it's way out there. I grew up in a little farming community where everyone had really big families. So I've got almost 50 cousins just on my dad's side. And I honestly, if they're under the age of 30, I don't know who they are. I can tell you what family they're part of, but these are the people, if I didn't do a proper plan and in the absence of having those first few degrees of distribution, these are the people who would inherit my estate and split 50 ways. It won't be much, and it'll be to people that I really don't have a relationship with. So it's important to think about that implication if you don't have a will. Those who inherit your stuff, it may or may not be who you would want it to be. When we talk about charitable giving, and if you don't have a will, charities will absolutely receive nothing. If you don't have a will. Guardianship, again, it may or may not be who you would choose. People make decisions based on the information that they have at the time, and they change this, especially guardianship. We see this one get changed quite a bit, where you choose a sibling or a family member as a guardian. Maybe you choose your parents and your parents get older and you realize they're probably not the best options, so you switch to a sibling or to family friends or whatnot. This is a fluid process, and so you change these things often as time goes on. And if you don't have a will, you don't get any say in that. So don't panic and think that the government will get everything if you don't have a valid will. It's only if you literally have no other family members through 5 degrees of distribution that the government would inherit it. And again, even if it was that situation, don't panic too much, because if the government ends up as the recipient of someone's estate, it goes to scholarship funding and things like that. It doesn't go to general revenue for some pet project that you may or may not agree with. And so you can sleep a little bit easier knowing that at least if it's going to that, which is way downstream from where it's likely to go, but at least it's going to fund education and things like that. So choosing an executor. This is a question I get often, especially with older clients who have adult children, and they say, well, geez, we don't want to be unfair to anybody. How do we choose? Who's the best option for us in terms of an executor? So I have some criteria that I like to follow that makes the most sense to me. Number one criteria should be trustworthiness, always. When you're choosing an executor, make sure that the individual you land on, you trust them with everything you own, literally. They are going to step into your shoes and follow your instructions. Hopefully your instructions are clearly drafted in a will so that it's black and white and they know exactly what their marching orders are. But if there's some ambiguity there, or some things that didn't make it into your will, they will step into your shoes and say, okay, what would this person do in that situation? So you have to trust them. That's the most important factor. A second criteria would be geography. It's important that you have somebody in Alberta if possible. Not the end of the world if you have to go outside the province or even outside the country. They can still do it. They can be legally appointed. It just creates some unnecessary barriers to them being able to act on your behalf. So geography is important, less important than trustworthiness, but it's important that if possible, choose somebody within the province of Alberta. They can avoid some added hurdles in administering your estate.
David, I'll just jump in for anyone listening. I know we have people from all over North America on this call. So just, I guess, just in your jurisdiction, not, me and David live in Alberta, but if you live somewhere else, Florida or wherever, somewhere in your jurisdiction, just to clarify for everyone.
Yep.
Please continue.
Yep, for sure. The third criteria that I would address would be somebody who has some knowledge of how these things work. Somebody who has friends or colleagues who are lawyers or accountants or financial planners or people in real estate, whatnot. You're going to need all of these people. So somebody who knows how to do this basic stuff. They don't need to have been an executor or a personal representative before, but it helps if they have some basic understanding. For me, my wife is my first executor. The alternate that I have is my youngest brother. He's a journeyman carpenter. He builds beautiful things out of wood. probably doesn't have a clue how to file a tax return. If we're being honest, he probably has no idea how any of that works. He doesn't hang out with lawyers and accountants and whatever. He is hands down the right choice for me because he's the most honest person I've ever known in my life. So he'll figure it out. He'll stumble out of the gates and say, okay, I guess I probably need a lawyer or an accountant or one of those suit and tie type people. But he'll be honest about it. And so absolutely the most important criteria there. So trustworthiness, geography, and then knowledge would be the top three for me. Some other considerations in choosing an executor would be age. If your parents are in their 70s, they're probably not the best option for guardian or executor. They might be capable of doing it, but you have to think this document is in place until you change it down the road. And if your parents, age over the next 5 years until you make an amendment, and then the probate takes a year or 2 years after that, you have to consider the implication of burdening an elderly parent with that. So age is an important consideration as well. Consider also somebody who has the time. Anyone who has been an executor before, or what we refer to as a personal representative, it's a blessing and a curse. Oftentimes it feels more like a curse. It can be a lot of work, for sure, to be an executor for somebody's estate. And so think about that. If you have somebody who has a bunch of kids and a busy career or whatnot, maybe they're the best choice because they're the most trustworthy person in your life, but you have to consider that, do they have the time to dedicate to this as well? So a few important considerations in choosing an executor. All right. I want to emphasize next how easy it is to have a will in place. So you've got a couple of options available to you. You can go see a lawyer who will do a good job, draft up a will for you, make sure you see an estate lawyer, so they've done this before. You can get a will kit. Please don't do that. Will kits are a horrible idea. Lawyers love will kits because they're always done wrong. Lawyers will pick them apart. If there's any challenge to the will kits get tossed immediately. I can't tell you how many times I've seen somebody come in with a will drafted from a kit, and it has the wrong language, and it has improper witnesses, and it has, there's just flaws throughout. As with all things in law and often in life, you don't know what you don't know. So you might do a will kit where somebody, guarantees for the low price of $50 or whatever, you can have a valid will. 99 times out of 100, it will not be a valid will. It will end up with, errors, mistakes, and you could have saved yourself the money and the headache and the burden on your family and your loved ones left behind by simply not doing a will. You'd be better off by not doing anything rather than doing a will kit. So if you have a will kit, burn it, shred it, light it on fire, run over it with the car, but whatever, get rid of it. Here's your best option. If you have barriers to getting a will done, which include time or finances or not knowing a lawyer or whatever that might be, in Alberta specifically, you can do a legal will that's called a holograph will or a holographic will. Both terms are acceptable. A holograph will is a handwritten document. It's not a typed document. You don't sign it. You don't type it and sign it at the bottom. You handwrite the whole thing. You don't require witnesses. It's as simple as sitting down at the kitchen table, dated at the top, appoint an executor, make sure you leave your stuff to somebody, some individual or individuals, sign it at the bottom, and you have a 100% legally binding will in the province of Alberta. It's free. It costs you an hour of your time to do that. So anybody who doesn't have a will, if you're in that 50% of people in Canada who don't have a will, you're out of excuses officially. This is a dead simple, absolutely free option to put a will in place, and it will literally cost you an hour of your time. It's a stopgap measure. It's certainly not as good as a lawyer drafted will, but it is much, much better than a will kit and cheaper too. what we often hear with our clients when they come to us and they're ready, they've overcome the time or financial barriers, or they're in a position in life where they're ready to do a formal will with a lawyer. We hear often from our clients when they get to the end of it, they say, man, that was easy. I don't know why I waited so long to do this. Total time commitment from our clients is almost always between 2 and 3 hours is all they will invest into this, from initial meeting with a lawyer to, filling out the instructions. We've got a form we send to our clients to fill out. It gets the conversation started between spouses or for individuals to start thinking about who they want to appoint as an executor and who they want to leave their things to, what charities are important, what provisions they want in there. We hear this at the end of it when we sign everything. They say, man, there's no reason why I waited so long. I've had times in my career where I've seen more clients than I care to admit who are in their 90s, literally, who are doing wills for the first time. Those have happy endings, those stories do, because they got it done. Better late than not at all, for sure. They say, yeah, I've been meaning to do this for a while, and under my breath, I think, yeah, like 60 years, 50 years, you probably should have done this a while ago, but we're glad you're here, and we'll get this taken care of for you. So I've got a few minutes left, so maybe I'll just talk about a couple of
David, let me jump in here. So again, I should have said it right off the top, but please, if you have any questions, we're going to have Q&A at the end for both David and Danica, who will be speaking after David here. And again, if any questions should come up for myself or Walter, as we spoke yesterday, by all means, put them in the Q&A. But David, I have a couple questions just of my own, just that just sort of came up. So, so let's call them rapid fire. I think they'll be pretty simple. So you said about 50% of people don't have a will in Canada. Would that be generally? I realize you're in Alberta and I guess qualified in Alberta, but would that be sort of similar worldwide, generally speaking?
I would say it's similar across North America.
Okay.
Outside of that, I couldn't say.
And then here, I'm going to put you on the hot spot here a little bit, or at least your profession. How many lawyers, and there's obviously lots of different kinds of lawyers, right? Do not all do wills and estate plan. What's the percentage of lawyers that actually have their wills done?
Ooh, not 100. I can tell you that. Okay, not 100. It's not uncommon that we see quite a few people who, I've done lots of wills for lawyers before. Okay. So
fair enough. And then you talked about the executor and how to pick one, but you didn't mention using like a firm to be the executor. Can you touch on that maybe quickly? For sure, yeah. So it's a viable option for people who have nobody that they trust or that they're close with in their lives. On the upside, so, every major bank will have a trust division who can handle being the executor, obtaining a grant of probate, distributing the estate, doing all the stuff that an executor would do. On the plus side, they're professionals. They'll do a good job. They'll do it. They'll be efficient with it. They are, in many ways, a good option for an executor. On the downside, you will pay through the nose for it. They are very, very expensive in comparison to appointing an individual as an executor. People ask us often, what's an appropriate compensation for an executor? And it depends really on the value of the estate, on how complex it is, but somewhere between 2 and 5% is an appropriate amount. There really isn't a wrong answer, but that's an appropriate range that I think the courts would probably adhere to as well. If you're appointing a trust division of a major bank, you are going to pay much more than that for their services. So you'll pay for them to act as the executor, you'll pay for their legal division to obtain the grant of probate in addition to the executor fees. If there are trusts established for minor beneficiaries, you will then pay their investment division to manage that. So if you appoint Scotiabank or Royal Bank or TD, all of a sudden you're going to have their investment division managing the estate assets. So you kind of end up with potentially 3 different arms of that financial institution benefiting from it. So on the plus side, they will do a good job though. If you are an isolated individual without close family members, I wouldn't be somebody to talk you out of it, but you do need to be aware of how it's going to deplete your estate. Okay, another question here. You talked about the holographic will or hologram will, so something to that effect. You talked again about Alberta. Would that be, or Canada, would that be generally sort of same standard across North America or the world as well?
Yeah, so it wouldn't. So it would vary province by province and state by state. This is because property and estate legislation is confined to each individual province. And in the U.S., for example, it would be similar state by state. They have their own rules, and they vary quite a bit from state to state. So in Alberta, we're a bit cavalier about this kind of stuff. We've got agricultural roots. We've got a military history. This is where holograph wills came out of. And so we're a bit more cavalier about things here, and we allow handwritten wills. They're a great option for people, but if you're in a province outside of Alberta or a state in the US, make sure you talk to somebody local and make sure that's a valid option. It definitely is in some places, but it's not universal.
Okay, I'm going to go back to the executor. Can you not also have, again, this probably state by state, province by province, et cetera, but have sort of an appointed person, someone you trust, but then have sort of like a backup or like a secondary that can assist that person or something to that effect?
Yep, can and should. Absolutely, you should. Yeah. So, and again, this is something it's important to remember that when you do your will, especially with a lawyer, it's not a one and done process. You'll do it. And then as life circumstances change, which they invariably will, you will do it again. It might be people coming and going in your life. It might be marriage or divorce or kids being born or losing loved ones or whatnot. Life doesn't stand still. So circumstances will change for you. And so you should name a primary and you should name an alternate, and you will change those people over time. Almost no doubt about it.
Okay, great. Sorry, yeah, continue on then. Those are my questions.
So I've got just a couple of minutes here, so maybe I'll just address a few things. So when you do an estate plan, if you're dealing with a lawyer, make sure that you make it a team approach. There are other people that you should talk to. I deal with outside professionals all the time with estate planning, in particular accountants and financial planners. Lawyers are not the best people for tax advice. For basic things, it's not a problem, but for complex things, you want either a tax lawyer or a tax accountant to be involved in this. If you have a financial planner that you work with, somebody who manages your investments and your retirement savings, you absolutely want them involved in this. I'm not the money guy. I'm the legal wording guy who writes things down and wordsmiths the document to make sure that it meets your expectations and properly conveys your instructions. If you have a financial planner, they're the money person, and they're the person who knows what your retirement goals are and how you're going to achieve them, and they should play an active role in this for sure. So make it a team approach, especially with lawyer, accountant, financial planner, possibly others if that's applicable. This is kind of an odd one, but if you're not a sentimental person, you should become a sentimental person when you do your estate plan. It sounds odd, but if I use my own example, my mom has a china cabinet full of crap that my generation and the generation after me, they really don't care about. But it's important to remember when you hear the stories about why that's important to that person, it carries new meaning, and you create family traditions and heirlooms that get handed down. So become a little sentimental and make sure that you tell those stories. Make sure that you leave personal property items to the right recipients of that property. And second to that, tell the story. Make sure that they know why it's important. If you give somebody some dishes, they're going to say, great dishes. But if you tell the story about these dishes came on a boat across an ocean and here they are and they went on a wagon and when a family came to Canada or whatever, it carries new meaning and it's important. So become a little sentimental if if you are leaving personal property items. We've seen clients often who leave items of very low monetary value to an individual and tell an amazing story about it, and that becomes a family heirloom. It can be something as simple as a print on the wall that reminded an aging parent of their kids who were long since gone, and they smiled every time they looked at it and thought of their son or daughter or whatnot. Tell those stories. Don't let that get lost to history. So it's really important that you become a little bit sentimental when you do your will and deal with those personal property items. Write letters. I spent my high school years in the garage with my dad under the hood of old hot rods. That's how we spent all of our time. And so those are happy memories. There's not, we're not talking about big value cars there, but the memories are important and the stories are important, and those stories need to get passed on to other people. So make sure that you do that. There are a few other things that I can address. I think I'm right up against the clock here, so I'm going to leave it at that, unless there are any questions that.
No questions at the moment, but I think they'll come in. So again, I'll just encourage everyone, if you have any questions for David, pop them in the Q&A, and we'll get to them afterwards. Before I introduce Danica here, I just the sentimental, probably something I need to work on myself, because I've unfortunately, we had to clear out a couple of my wife's side of the family, a couple grandparents' homes in the past, and we are holding stuff which don't mean anything to me, and they look like they're just taking up a lot of space. But I guess we could all, I'm speaking for myself, could be a little bit more maybe sensitive to some of those things that I guess I just haven't heard the story as of yet. So
yeah, there's probably stories with all that stuff, right? So it's a shame that it gets lost to history and it just becomes stuff at that point.
For sure. So I'll have to work on my own personal growth there. So thank you, David, and David will be staying on for Q&A at the end. So I'm going to introduce Danica now. So Danica is our mortgage broker extraordinaire, mother of four, self-described aspiring Disney princess. Tons of experience in the banking industry and as a mortgage broker. And she is here to talk about where we're at with interest rates recently, and how she can help with mortgages and whatnot. And Danica, you're just on mute right now, so make sure to unmute yourself.
My bad, sorry.
Well, no problem. Welcome.
Thank you very much. I appreciate it, GFAC. So today, sorry, go ahead.
Oh, I was just going to say, we've had a bit of a lead in here for you. We've had in just the last, 6 weeks or maybe 2 months now, we've had essentially 2 emergency rate cuts, both here in Canada and in the US. So, I guess with that as a starting point, take it away.
Thank you so much. Going back on what David said, when we my husband and myself looked into planning our will, and we say estate type stuff, but that seems way bigger than me. But David, you made it super easy, and it became such a friendly transaction, like you said. So thankful that we did it, and so thankful that we had the knowledgeable people behind us to really make a safe will for us and our families, really, because with 4 kids, they all want a piece of it, and we do have extended family who are probably all going to want a piece of it at some point. So it's really great to have you in my corner, Dave. Thank you so much. So on to the Bank of Canada's all of a sudden urgent, no prompting rate drops that we saw in March primarily. It's the first time in history that rates have dropped so drastically for everyone who has a mortgage, who has a line of credit, who has anything that is really governed by the Bank of Canada's choices and rates. And I was going to get a little bit into how rates are chosen and kind of what makes them stable and what makes them not stable, but it's a lot. So if anybody wants to have that discussion, just let me know. But with regards to the value of the prime lending rates that the government's established for us, back in October of 2018, the government threw at us 3.95%, which was still relatively decent in the grand scheme of things. It has been upwards of 6.5, 6.75 in the last 15 years. And last year, we'll even say, 6 months ago even, we did have such rates such as prime lending for variable rates anyways, prime of 3.95 minus 1%. Minus 1.24%, whatever the case was. There was a lot of really good rates. And so those rates were looking for the general public, 2, 2.5, 2.75%, depending on what the offer was at the time. And then all of a sudden on March 6th, it goes down to 3.45. And the general public is like, wow, how does that affect me? And then on April 1st, and then April 2nd, it's already down to 2.45. So I personally got a call maybe a week and a half or 2 weeks ago from a client who just wanted to say thank you for urging them to go with a variable rate mortgage, because they're now paying 1.3% on their mortgage. And that is completely unheard of. That is the lowest they probably will pay at this point. And it's good to see. I think they're feeling less of a pinch because their mortgage rates were adjusted to meet that low rate, and they're feeling the benefits of it, I guess. With regards to fixed rates, those are all determined by the government's bond rates. And bond rates are really determined by what kind of money the government is selling to other countries. And it gets a lot deeper than that, but we, again, don't need to go into that too much. But today's 5-year fixed rate, and it changes almost every day depending on the lender, is as low as 2.49% for 5 years, which is still really, really good. For variable rates right now, we have somewhere along the realms of the 2.45 minus 0.2%, minus 0.25%. And so you're still getting a good fixed rate for the course of the whole 5 years. One of the huge benefits to a variable rate, all really dependent on what your plans are, because, you know, even like David West was saying, we can't foresee the future. We don't know what's going to happen. But all of a sudden, someone loses a job. Someone gets a job in another province. What are we going to do with our house? There's going to be such a big penalty. Maybe, but with a variable rate mortgage, if that's what you have, you're paying a big whopping 3 months interest penalty, which is significantly lower than what you would pay. Unfortunately, it is like the bigger 6 banks that have a higher penalty just because of the way they calculate it. But with any variable rate, with any lender in Canada, you will be paying only that 3-month interest penalty to get out of your current mortgage, if for whatever reason you need to sell. And I think the average person goes through 3 3/4 years into their mortgage and they change it up, whether it's for rate, for circumstance, refinance, early renewal, whatever the case is, people change it up all the time. And, you know, the 4-year rate is not even usually as good as the 5-year rate, but again, it just depends on what your plans are for the future and what that looks like for the current home that you live in. Same with rental properties. Sometimes people have to sell it to give themselves a little bit more liquid assets, to invest in something else. They sell their rental property, and it's fine. It's totally personal preference. No one's going to be upset that you did that. Another thing I wanted to talk about was the qualifying rate, the stress test, if you will, and how that really affects you today. So back about a year ago even, the government, I think it was a year and a half ago, the government came out telling us that the qualifying rate for you to get a new mortgage was as high as 5.49%. No, that's not the rate you're going to be paying, but the government put that and instilled that rate to make sure that if and when rates go up higher, which it didn't do, but just in case rates went up higher, that you'd still be able to afford your mortgage payments. Because I know a lot of people had this low 2.25% fixed rate for 5 years, and all of a sudden rates are in the high 3s last year, and wondering how they're going to be able to afford that. Well, there was a couple of lenders who had some fancy products that allowed you to renew your mortgage at the qualifying rate of whatever the rate they were offering is, which is fantastic. That is a true win for the client who was paying that low of an interest rate. And now they only have to qualify at the 3 point whatever percent. A huge win for the general public again. The qualifying rate was then went 2.49, went down to 5.49, went down to 5.14. So again, the brokers more than anything, and anyone in the banking industry was so excited about this because it changes up a lot for, again, the general public. And then recently went down as low as 5.04% to qualify for your home, which is a huge win again, because people were able to purchase a home that they could afford based on this qualifying rate. They might get a little bit more. Instead of qualifying for, we're going to pick round numbers of 300,000, they might be able to go up to maybe 320. And that can go from a duplex or a townhouse to an actual single family home, single family dwelling. And that's, again, a big win for people. That's pretty much all I really wanted to talk about. Did you have any questions at all, Deepak, that you were kind of thinking?
Yeah. Just to reiterate to everyone, if you have any questions for either David or Danica, throw them in the Q&A. I do have some questions here. Maybe I'll start up. Yeah, you kind of briefly touched on it, fixed versus variable. Maybe just a tiny bit more on sort of the difference and why someone might want to do one versus the other. And I guess, and maybe again, just maybe a little bit more color on how that's determined.
Yeah, absolutely. That was actually one thing I was thinking about talking about at first, was the fact that many people have reached out to me in the last couple of weeks, and including the guy who has 1.3%, saying, can I lock in now? The thing is, with a variable rate, it's all depending on what the current Bank of Canada rate is. And if all of a sudden you have 1.3%, you don't get to lock in at 1.3%. You have to lock in at whatever the best, if you have 2 years left, you can lock into the best 2-year, 3-year, 4-year, or 5-year term mortgage and start your mortgage all over again with that best rate. So if you have a variable rate, do not lock in at all, because you are winning, we'll say, the rate game right now. You are truly winning that rate game. So stick with it. I'd be happy to talk to you about whatever new rates I have for you. If you're up for renewal anytime in the next even 2-3 years, let's talk about what some options are, because you could be saving even thousands of dollars in interest. Why pay the banks the interest? They clearly made X amount of billions of dollars last quarter anyways. I'm sure they can suffer a little bit by not paying them a little bit of interest that is going to be paid through your mortgage. But I think that, like we said about variable rates, there is a lot of benefits to it. The fixed rates also have a lot of benefits to it, depending on if you like the game of roulette and you want to gamble a little bit about where the rates are going to be. The 5-year fixed rate, 25-year amortization is standard. That's what the banks are going to offer you, and that's going to be pretty much what they know. Whereas some people think, you know what, I'm going to play the game. I'm going to go with a 2-year at a slightly lower interest rate and play the cards, see where we're at come 2 years from now. And although the lenders do offer such things as the 3-year variable rate, it's not as good as the 5-year variable rate, but the penalty will be the same at the end of the day. So that's always something to take into consideration as well. Again, it's just kind of looking towards the future and seeing what your many options might be. Again, the fixed rate is very good. I'm happy with where rates are right now. I've been happy with where rates are for a while, but you are stuck in that rate. I won't even say stuck. You are locked into that rate for the extended period of 5 years. And hopefully everything goes well for you and the 5 years comes to term and you're looking at renewing your mortgage. Another thing I wanted to touch briefly on is your amortization, which is the time in which it's going to take you to pay off your mortgage within that variable or fixed rate for the term. So again, we'll go with the 5 years. If you decide, you know what, I think that because of the way my paychecks work, I like biweekly payments. Fantastic. Let's set you up for biweekly payments then. Your amortization goes from that, say, 25 years, which is the maximum the government will allow you to have at the moment. Then your term goes, or your amortization, sorry, goes from being that 25 years down to just over 23 years. Because when you do biweekly payments, you pay every 2 weeks. If you look at the calendar, that gives you an extra 2 payments per fiscal year. So you have the option of paying it down just a little bit faster than with the monthly payments. Same thing with semi-monthly payments. That's 1st and 15th or 3rd and, whatever the case is. You can pick the 2 Fridays, which seems to be a really happy medium for the most part. And depending on how you get paid, how your lender, how your employer chooses to make those payments to you. You don't need to have a 25-year amortization. If the payments make the most sense to say every 2 weeks be $700 instead of $692 or $685, whatever the case is, we can actually change your amortization at the beginning of the transaction and make it 23 years and 8 months. If you want it to be 19 years and 3 months, no problem. We can set that up as well, because 25 years is just kind of the staple. But you don't need to have 25 years. And that's one thing that I love to be able to show people, is the fact that we have so many options. Don't think of the staple as being what is required. The only requirement is that it has to be a maximum of 25 years. So that's just something to look into, what works best for you. And again, happy to play with numbers to figure out what works best for you and your family. Go ahead. Were you going to say something?
Oh, I just had a question, but you go ahead and I'll
No, it's
ask my
okay.
question.
This is another topic really quick.
Yeah, you go ahead and I'll ask my question at the end.
Okay. Another thing I wanted to touch on really quickly is your credit score and your credit bureau, because a lot of people not only have never seen their credit bureau, but also don't understand it. So small things like making your payments on time. That's a huge thing for keeping your credit score good. You don't want to max out on your credit cards. That's a huge downfall because you're told to be kept, I believe it's 75% of the total value of your credit card. You're supposed to be below that to keep your credit score higher. The higher credit score, yes, it can benefit you rate-wise because some lenders say, well, clearly this guy, Joe, I don't know, I'd like the name Joe today, but Joe knows how to maintain his credit. Joe makes his payments on time and it's a huge win for him. So we're willing to stretch the rules a little bit, not crazy amounts, but just a little bit. So that's just one thing with regards to credit bureaus is when a mortgage broker pulls your credit bureau, we see the whole picture. We see if you've made a late payment, if you've missed a mortgage payment. And the unfortunate part is that cell phones now show up on your credit bureau. So if you chose to not make that payment this month, it could be a huge downfall for you because it shows that it's a slow repayment history. So it's a good idea to just make sure you don't overdo, sorry about that, you don't overdo it on the credit that you have. Don't max out your credit cards. Don't try to overindulge, I suppose, with using the credit that you have available to you through your credit cards, line of credit, whatever the case is. And please don't go applying for credit cards everywhere because it will hurt your credit score. It will really, really hurt. Seeing that people are looking into your credit all the time, it's more considered a hard hit as opposed to a soft hit, which is things that your cell phone company, your bank sometimes does a soft hit to make sure that you are keeping your credit in good standing, that you are not being unreasonable with your credit. So credit bureaus are something I could really talk about all day long because I love the fact that I've been able to show people exactly what it looks like and why. Because a lot of times the lenders and the banks will not show you that. You have the ability to go to equifax.ca and figure out where your credit's at. And if you don't understand it, again, please reach out to me for me to be able to help you with determining and deciphering exactly what that credit bureau means to you and how you've gotten there.
So if I could I'll jump in now, I think, a logical break there. So I had one question of my own and one that a family member sent to me who couldn't make the call today. So I'll start with my own first. So we are in a position where we have a year and a bit left on our 5-year fixed. Obviously I live in Canada, so it's a Canadian example. And we're fortunate enough that we got at pretty decent rates the last lower cycle, let's call it that. And now that we've kind of come full circle and at a low cycle again in the 5-year fix, that's what works for us. We're comfortable with that. Is lower, but, and I think Danica, we've had a brief conversation on this, and I've talked to a few other people as well. Because I'm and you touched on this earlier, because I'm in a 5-year fixed, the penalty to get out early to take advantage of just the slightest little bit of difference maybe doesn't make sense. So I guess obviously it's individuals and talk to a professional, but maybe you could just speak to that very briefly.
Absolutely, Deepak. Thank you. I think that you have to weigh the pros and cons to spending that anywhere from $2,000, $3,000, $4,000 to save that $16 a month. What does that look like for you? Are you willing to spend that, again, $5,000 to save yourself that couple of bucks? Does it make sense? What does it look like in the long run? But then again, if you go, we're going to just pick random numbers. If you're paying 2.99% and I can get you 2.4% 2.59%, it makes a little bit of sense because you're going to be saving that money, but also you're locked into that new 5-year at 2.59. So you are now locked into that rate, and you aren't going to have to succumb to whatever the rates are in the next year and a half for your mortgage. And again, my crystal ball is currently not working, so I can't tell you what tomorrow is going to hold or what rates are going to look like even 6 months from now, because Lord knows we don't even know what's happening with this whole COVID business. We have no idea what's going to come of this. If the Bank of Canada is going to lower it one more time to reach that low, the lowest in the last 15 years was 2.25%, and we lived through it. Good old '07, we lived through that. And I think that the government is currently happy with where the general economy is, and I don't foresee that they are going to be lowering the Bank of Canada rate again anytime soon. Again, COVID could play out another 3-6 months, and maybe in a few months they'll look at changing it depending on how the economy is and how the general population is doing with the debt that they have.
Okay, so I'll just remind everyone, if you have a question, we're almost kind of into Q&A anyway, so please pop in a question into the Q&A box. So this question came to me offline from a family member who couldn't make today's call, but generally speaking, their situation is such that they've always had, with fluctuation in income levels month to month, that sort of thing, not static. That they've always gone with a 5-year, or fixed, I should say. I think typically 5-year, just for that certainty of knowing exactly what has to be paid. They're coming up on renewal here shortly, like within the next couple months. Now, with of the family unit, one is underemployed now because of COVID. One is working but has less income than they typically would have. So their lender has come back and, here's the terms, and, kind of pre-approved already, just move forward. Versus, so they came to me for advice, and maybe I'm not, I think I know a little bit, but I'm not a professional in that for sure. So the advice I gave them is, look at, and this kind of ties into what Walter talked about yesterday to a degree as well. I said, my personal opinion was, I don't think the Bank of Canada is going to be raising rates, any hurry to raise rates for the next year or two, at least, possibly 3, but let's call it 2 to be conservative. So my suggestion was to them, go to your lender. I can see that they don't want to maybe go outside their lender because they don't have to requalify or prove income again, et cetera. Go back to your lender and just get quotes for, a 1 or a 2-year variable, and maybe save money in the short term. And then if, rates look like they're going back up, you're probably not much difference than what you're getting offered now. So that was kind of the advice I say, at least get the numbers. You have all the information before they make a decision. But am I offside here? Did I give them bad advice, or at least somewhat okay?
I think you're on par with what they should be doing, especially if there is a decrease in income. Unfortunately, they don't have a 1 or a 2-year variable rate. It's a 3 or 5. The penalty is the same regardless of if you're in a 3 or a 5-year variable. But with a variable, another thing that is a true benefit to it would be that at any given time, you can lock in to that, like I said, 2, 3, 4, 5-year fixed rate, whatever their best rate is. You can go back up to that without requalifying. So I think that the way you're saying it makes a lot of sense, because with prime minus, say, 0.2, they're paying 2.25%. That's pretty darn good for 1 year, 2 years, whatever we stick at for the Bank of Canada's rate. If we're able to keep it this low for an extended period of time, then they truly are winning. I think that you are again on par, saying that just wait it out, like benefit from these low rates. And if and when things change for them financially in the next 2-3 years, at that point, you can see if maybe you want to lock into the better fixed rate, if that's an option, or just, like I said, gamble and see where rates go. Because people were paying 2.95% and thinking that was pretty good. And now they're paying 1.3%. So it's not a negative. I think with a variable rate, people will always come out winning at the end of the day. For a few of my friends and clients that I got into a variable rate, it was only prime minus 0.4, prime minus 0.6. They did have to go up to that 3.4, 3.5%, but now they're down to below 2%. So it's just having to wait it out. Don't jump at what you see. Think wholeheartedly about what the situation is and how this is actually going to affect you long term. So definitely good on you, Deepak, for suggesting to just go with what the lender tells you at this point. If you want a variable, see what they'll do to get you that variable rate at the moment.
Maybe if I'll just, Walter, if you want to unmic yourself, do you have any thoughts on that, just as far as rates and kind of in relation to what you were talking about yesterday on the market and where you see the market headed?
Yeah, so again, with the market, we're going to see some positive numbers for a little while here until bankruptcies get caught up and unemployment gets caught up. And then I think we're going to, like I said, the coronavirus pandemic is not over, or at least the outcome of it moving forward. So I don't think we're through it. I think we're going to see more headache and more downturn in the market. That's my opinion. And I agree with Danica with interest rates. I'm a huge fan of the variable rate. So just to plug into Danica that, because I was a lender before as well too for a few years, and there's studies out there. You can just even pull them up on the internet. Are you better off with a variable rate, or are you better off with a 5-year fixed? And there's a reason why they push the 5-year fixed. You can probably guess what that is. They make more money. But yeah, you're much better off with a variable rate mortgage. And I've talked about that for years. You're better off with a variable rate mortgage because it does save you a lot more money. I think it's like 96% of the time you're better off in that environment than a fixed rate mortgage. So reach out to Danica. She's got a lot of good insight there, and I agree with everything she says. So
Thank you.
that's my input and my take. And if there's any other questions, I'd be happy to answer them for you.
Danica, did you have anything else you wanted to add before we officially go to Q&A session?
Walter brought up the bankruptcy situation, and of course, again, I could talk about that for quite some time. I know I actually got in touch with a company called 4 Pillars Debt Insolvency, and told them that they need to get in touch with me before they put people into bankruptcy and consumer proposal, because I've actually saved people thousands of dollars a month by refinancing their mortgage, taking out enough equity to pay out their $10,000, $12,000, $13,000 in unsecured debt, and getting them a new mortgage, maybe at a slightly higher interest rate, but getting them a new mortgage at, call it 4%, and saving them, because, what's your credit card at? Anywhere from 11 to 25% interest. And that's just not attractive to be paying the lender, the bank, that much money on your credit cards. So if we can refinance you and pay a slightly higher rate depending on where your credit's at, let's look at that as an option, because your unsecured debt's not going to go anywhere. It's just going to reside there. And then, go long term, your will and your estate planning is going to end up being the one paying it out at the end of the day. So pay it out now and seek the benefits and reap the benefits of that, or wait long term and just continue to pay the bank all that extra interest that you don't need to pay.
So Danica, we did have a question that come in through the Q&A box, so I'll just read it out to you. So for a household whose resources, I'll paraphrase a little bit here. For a household whose resources are such that they're just affording essentials right now, and the bank has offered to I think push the payments to the end of the loan. So I guess not making any payments, monthly payments or whatever the frequency may be, but pushing it to the end. What are your thoughts on that?
Well, if we're talking about mortgage deferrals and whatnot, it's a very, very short-term solution that will cost you money at the end of the day. I can completely appreciate with the job market and how the employment's going right now, that essentials are what is essential. You need your food. You need to, find out where your money is best spent. If you can get a couple months off of making that extra payment to your mortgage, then, if it benefits you right now, take that advantage. Adding it to the end of the term of your mortgage makes sense, but it will cost you. It's not free to do that. The bank is not in the business of giving money away for free.
Okay. We'll wait for another question to come in. I had a question for David that I wanted to ask earlier, so I'll just ask it now. So David, we talked about your wills, specifically, mostly about that, but there's other documents that go along with estate planning as well, powers of attorney, et cetera. Did you maybe just want to briefly touch about those and the importance of them, and then just a little bit of a teaser to anyone that I think in the near future, maybe a couple of weeks out, me and David are going to have probably a little presentation more specifically on that, but I'll just leave it at that point for now.
Yeah, for sure. So when we do this, and I'm glad you asked the question, we package the will, the enduring power of attorney, and the personal directive all together because they're all really important and they serve all different purposes. So if you look at timeline of your life from birth to death, for most people, usually somewhere in here, you may lose capacity. Alzheimer's, dementia, stroke, maybe at some point in your life you have a traumatic brain injury, whatever the reason why. Individuals can lose capacity to make decisions for themselves. The enduring power of attorney and personal directive come into effect when that individual loses capacity and the authority under those documents terminates upon death. That's when the will starts and the authority of the personal representative starts upon the death of the individual. So what you're doing with those is the enduring power of attorney, you're appointing somebody to deal with anything related to your finances, really. So it can be simple things like bill payments, managing rent or mortgage payments, a bit more complex, such as filing your tax return on an annual basis, and the much more complex, they can manage your investments, they can buy and sell within your portfolio, they can do all kinds of stuff. So you're giving broad authority, generally speaking, to somebody to manage your affairs, your financial affairs. The personal directive is along the same lines. You're granting authority to somebody as your agent to make more personal decisions. So we always think of end-of-life care under a personal directive, which is definitely accurate. Typically, though, this is the more mundane. Grandma goes into a care facility. Who's going to choose which facility she goes to? Well, it'll be under a personal directive if grandma has lost capacity to decide for herself. That person becomes the contact person, the first point of contact. And a decision maker about the well-being of that individual, organ donation, end-of-life care, those types of things. These documents are important in and of themselves, but if I can stress a little bit the importance of these documents, all three of these documents, as somewhat of an insurance policy. You hope you don't need your enduring power of attorney, or if you need it much, much later in life. If you don't have these documents, the enduring power of attorney and the personal directive in particular, what you're doing is you're going to get a court application to get trusteeship or guardianship. And so if you have a younger person who has an accident and they suffer a brain injury, somebody in that person's life is likely going to court in the absence of a power of attorney and personal directive. They're going to court to get to make an application for trusteeship and guardianship. So when we package these up, so our firm, we flat rate just about everything we do. We charge $1,000 for couples to do a will, an enduring power of attorney, and a personal directive. So 6 documents for 2 people for a flat rate. If you didn't do an enduring power of attorney and personal directive, you're probably going to spend upwards of 6 months in this process of applying, making a court application, an appearance in front of a judge, whatnot, and easily a couple $1,000s on each of those documents just to get them in place. The end result is exactly the same, whether you do a preemptive enduring power of attorney personal directive, or whether you decide that they're not important and then something tragic happens and you're going to court to get the trusteeship or the guardianship. The end result is the same. If you like paying 10 times more for things and spending 6 months of your life navigating the court system, then by all means. But as an easier, proactive solution, having those documents in place makes a lot of sense.
So I think a general theme here for our 2-day talk, again, navigating the coronavirus, how to not only survive but thrive. I think the gist is, whether it's myself talking about I talked about immune health yesterday, but just health in general. Whether your financial plan, mortgage interest rates, estate planning, etc. I think being proactive really helps. Getting ahead of it really helps. So I think, it's a very tragic situation in many parts of the world right now, for sure, and no doubt about that. People are losing their lives, but for those of us who are in a position, we might be hunkered down. Maybe we've lost our jobs, or our spouses have, or what have you. But now is the time to, I think about all these things that we've talked about in this series, and hoping that's what I think we wanted to convey as well. So again, just if anyone has any other questions, please pop them in. But to the rest of the panelists, any final closing thoughts on either what I just conveyed or what the other speakers had discussed?
I think for myself, I just wanted to reiterate the importance of talking to a professional, because your mom's opinion on going with someone specific may not actually relate to you and your situation. Don't always listen to what your parents' advice is. You need to sometimes reach out to someone that might have a little bit more information about your situation, and they want the best for you. Not that the banks won't, because they may, but reach out to a mortgage professional, reach out to a lawyer, and get the best advice possible, as opposed to asking things on Facebook, because it's really not as legit, because it's that person's opinion. Whereas the professionals like myself and David and Walter and Deepak, we have legit information on the situation that might be best for you.
Well said, Danica. Thank you.
Thank you.
We haven't, we did, sorry, a new question just came in. Okay, so the question is, this person has read that the housing market, in brackets bubble, was set to crash in 2020 prior to COVID-19. With that in mind, with this whole scenario, what is your take on the true nature of the foreseeable future, I guess in general, in the housing market? And I believe this person is from the US, so just maybe keep that a little bit different market, but just I guess that keep in that context.
Absolutely. I mean, with Donald Trump making random decisions and stuff, I can't really comment on what's happening in the US. I say there's many mortgage professionals within the Alberta Mortgage Brokers Association or in the Mortgage Professionals Canada. Everyone is believing that, I wouldn't say it's so much a bubble, but that the price of houses will increase, and there'll be a huge influx in required mortgage information and applications come September, October, maybe even November, where people can actually maybe refinance their homes and take care of the debt that they've incurred throughout this COVID business. Because again, like I said a few minutes ago, paying 3 or 4% on a credit card or on your mortgage and refinancing is better than paying 20% plus on your credit cards. So I think there's going to be a lot of, with people back to their jobs, with the employment rate going up a little bit, I think that with the price of houses going up, you're going to have a little bit more equity, whether it's pretend equity or not. You're going to have the equity because of the increase in housing value that you're going to be able to play with and use that to your advantage.
I'm going to throw this to Walter to chime in just based on his discussion yesterday, but I know, I guess, I totally see your point, Danica, but also I guess it depends on how long we're going to last with this as well. Like I think just today, Toronto, which is, the biggest market in Canada, and maybe not somewhat dissimilar to certain markets in the US, this last month had declining home sale prices, because people are just not buying or not going out because they're in self-isolation, etc. So Walter, with what you kind of talked about, with the markets and that sort of thing, do you see something a little bit different, maybe more, not to say globally, but, I guess maybe more North American based and US specific to this question?
Yeah, a lot of times things are locally, like, North America specific or Europe specific or China specific. What's interesting right now is we are on a global recession. So we're not immune just in North America to what's happening. This is happening worldwide right now. So many countries are over leveraged, and an increase of 0.5% could really destroy or really weaken an economy in a country. So yeah, like I said, a lot of times it's just locally or Canada or the US. But this one's much different. We're looking at a global recession here. We're all in the same boat right now, especially with the coronavirus going on.
And obviously, Danica kind of mentioned earlier, her crystal ball wasn't working, and none of our crystal balls are working at the moment. But Walter, if with the kind of what you had said earlier today and again yesterday, that if we haven't hit the max or we haven't really hit personal bankruptcies, et cetera, then shouldn't be a stretch to think that there will be some downward pressure. I don't know if we're in a bubble or anything like that and be a major like 2008, 2009, but it shouldn't be a stretch to think that there should be some downside. Would you agree with that?
I would agree with that. And again, this isn't advice. I'm just going to throw that out there again. This isn't advice because we never know what the future holds, but I suspect we're going to see more of a correction and more of a downturn. Actually, you bring up Danica mentioned this as well too, but a bubble. Back in 1999, there was a bubble back then, and that was the tech bubble. People were throwing money into the .com companies when a lot of these companies had zero assets. And a lot of these owners of these companies were millionaires and even some billionaires overnight. Back then in 2008, we had another bubble, and that was the real estate bubble. And I also believe there's another bubble going on right now. So many people are throwing money into the ETFs, and there's some great opportunities there, but so much money is going in there. Is that another bubble? We just started thinking about that, and who knows? I think we're in a bubble right now as well, because everything is overinflated, and people, and this is human nature. We chase after what is going to give us the best return. That's just human nature, and ETFs are such a prominent way to invest right now. There's some good investments in there, no question. But like I said, I believe we're in another bubble, and it's gonna have to correct here soon.
So we had that same question follow up, but I'm just going to ask the person to clarify their question. I'm not sure I understand their question. So while they're responding to the clarification, I'll just reiterate again that for all registrants of the call, in the next couple of days or early next week, I'll send a link to both these recordings and any of the resources we've talked about. Walter discussed some books and some links, etc. yesterday, so he'll forward those on to me, and I'll make sure we send that to everyone. So let me just see if they have come back. So the question was, Walter, I guess you had said people are putting money, you mentioned ETFs into or whatever. People are putting money into things right now, potentially a bubble. So what are they? You mentioned ETFs, but what else are they putting money into right now?
Well, to me, that's the big one, and it usually is the big one. People are chasing after what is hot in the market. Like I said, in 2008, that was the housing bubble. And even banks didn't see that coming. They were, short selling their own, or not short selling, but really getting into the housing market and believing that it wouldn't fall apart. And then it did fall apart. And same with the .com in 1999. Those were bubbles. And so I believe we're in another bubble as well right now with ETFs.
So Walter, is that a move from mutual funds into ETFs, or is that just people are trying to play sectors as a whole as opposed to individual names? Like why ETFs? Why not Google or Apple or or whatever? Like why ETFs specifically, in your opinion?
That's a very good question. I'm not sure why that is, but why did everybody jump on board with the housing bubble or the .com, especially the .com? That one was a really interesting situation because people were literally pouring money into companies, into these .com companies that literally had no assets within that company. And just because the stock price went from, say a penny stock to, a few $1,000s, with no assets in the company, that didn't make sense. That was irrational way of thinking, but everybody wanted to jump on board on getting into the next best thing. Warren Buffett at the time says, I'm not doing it, I'm not jumping in. And he got a lot of flack for it. He was in the news for, people telling him, well, you should jump in because this is the next best thing. And he's like, I'm not doing it. And he never did it. And then who had the last laugh? Warren Buffett, because he really evaluates what he's putting his money into. And he knew, or he had at least a very good idea, that the .com companies weren't the way to be investing. And of course, people that were giving him a rough time before the crash had to eat their words after the fact. Hopefully that makes some sense.
Yes, that cleared it up for the person who asked that question. Thank you. So again, if we don't have any other questions coming in here, so again, in the registration page, we had bios for all the speakers, the websites for all the speakers. If you're outside of jurisdiction, please see a qualified professional in your area. If you're in, locally, please reach out to one of our speakers, where they may help you, myself included. If you have any other questions, in general about any of the topics, you can please send them to myself, and I can filter them directly to the speakers if you can't get a hold of them directly. We don't have any other questions right now. So maybe this is a nice point to end off here. So again, thank you everyone for attending this 2-day webinar, how to not only survive but thrive during this coronavirus crisis. And again, I'll be sending the links to the recordings and any of the resources that we talked about, especially the ones Walter talked about yesterday on day 1, out to all registrants in a couple days or early next week. So. Any last comments from our speakers or our panelists?
I think the one thing that I would just say really quickly is just to echo and reiterate what you said. With everything that we've talked about, an ounce of prevention is worth a pound of cure. And that applies to all of us. Do your homework, do your research, talk to the qualified professionals who know what they're doing, and just stay ahead of things as much as you possibly can.
Great advice, David. Thank you. And Walter, anything?
Yeah, I'm going to say that's bang on. Before you jump into anything, get to know what you're getting yourself into, and do your homework. Education goes a long way, so you can make a much more educated guess by getting educated, and you feel a lot more comfortable by your decisions. So talk to professionals and get their opinion.
For sure. And what I always talk about when I talk about, it goes across many topics, but certainly with health, it's a lot easier to do prevention before than to deal with it later at the end. So with that, I thank the two of you and Danica, who I think we may have lost, but thank you to all our panelists, and thank you to all of you who joined us for our 2-day summit. And again, please feel free to reach out to any of us. Thank you, and you guys stay strong during this period. All right.
Thanks, everybody.
Thank you.
Bye-bye.
See you later.
Bye.